Hello, thanks for watching and welcome to this video on the dividend discount model. As usual, a few things before we get started. 1. If you're watching this video because you are struggling in the class right now, I want you to stay positive and keep your head up. Now, if you're watching this video, it means you have accomplished quite a bit already and you are very smart and talented, but may have hit a temporary rough patch. Well, I know that with the right amount of hard work, practice, and patience, you can work through it. I have faith in you. Many people around you have faith in you, so should you. 2. Feel free to follow us by subscribing to this channel or on Facebook and LinkedIn at Prop Intel Limited. That way, when we upload new videos, you'll know about it. And it's always nice to connect to our viewers online. And 3. If you like the video, please give it a thumbs up, share it with your classmates, or put it on the playlist. That does encourage us to continue making them for you. On the flip side, if you think there is something we can do better, don't hesitate to leave a constructive comment below in the comments box, and we'll take those ideas into account when we make new videos. Finally, just remember that these videos are meant for individuals who are relatively new to finance. So it may be a student in an introductory finance or investment appraisal course, or someone who just needs to brush up on basic finance theory and concepts. And so, the presentation will be slow in a deliberate manner to enable you follow all the processes. Having said all of these, let's get started. Okay, so this video is on the dividend discount model, a method for discovering price of a company's stock or shares of a company based on the theory that its present day price is worth the sum of all of its future dividend payments when discounted back to their present value. It attempts to calculate the fair value of a stock irrespective of the prevailing market conditions and takes into consideration the dividend payment factors and the market expected returns. If the value obtained from the dividend discount model is higher than the current trading price of the shares, then the stock is undervalued and qualifies for a buy decision, and vice versa. A company produces goods or offers services to earn profits. The cash flow earned from such business activities determines its profits, which gets reflected in the company's stock prices. Companies also make dividend payments to stockholders, which usually originates from business profits. The dividend discount model is therefore based on the theory that the value of a company is the present worth of all the sum of its future dividend payments. So let's take a look at this. So an investor is entitled to two types of cash flows when he or she invests in the share of a company, i.e. dividends and the proceeds from the sale of the stock to another company or back to the company. The price of the stock is therefore the present value of these expected cash flows. Let's consider the following example. You are thinking of purchasing the stock of Tigers PLC and expect it to pay a dividend of £3 in 1 year time, and believe that you can sell the stock for £25 at that time. If you require a return of 20% on investments of this risk, what is the maximum you would be willing to pay for this stock? And would you purchase the stock if it is trading on the London Stock Exchange at £18 per share? So you will realize that both the dividend of £3 and the selling price of £25 will be received in a year's time, which totals £28. So by discounting this value to today, which is year 0, we will realize that the present value is £23.33. This is the maximum price you should pay for a stock of this company. Let's say you delay the sale of the stock for 5 years. What price would you pay for the stock? You will find that the price of the stock is really just the present value of all expected future dividends. In this example, we see that the stock is held over multiple periods, which is 5 years in this case. The investor will continue to receive the annual dividends over the period and sell the stock on the 5th year as laid out on this line diagram. This example is different from the previous example you have because in this case you have a series of cash flows, i.e. dividends, to be received each year for 5 years, and a lump sum, which is the sale price, to be received on the 5th year. However, the approach to finding the price of the stock is the same. We will discount each of the expected cash flows to today using the discount rate of 20%. Alternatively, we can value the series of dividends and the lump sum differently using the formulae shown here. The series of dividends will be valued using the present value of £1 per annum at I% for n years formula, as shown by this part of the overall formula. While the lump sum will be valued using the simple PV formula, as shown by this part of the formula. After substituting the right numbers into the formulae, we obtain a price of £19, and if this estimated price is greater than its trading price on the London Stock Exchange, then it means the stock of this company is undervalued, and therefore the investor can buy it at a lower price of £18 and sell it later for £19, thus making a profit. Now, let's consider a third scenario where the dividends are growing each period at a constant rate called G. This variation of the dividend discount model is known as the Gordon growth model, which was named in the 1960s after American economist Myron J. Gordon. This model assumes a stable growth in dividends year after year. This means that the dividend changes each year by the growth rate. So to find the price of the dividend paying stock, the Gordon growth model considers 3 variables. So it looks at a variable we would label as D, that is the estimated value of the next year's dividend. The second variable is denoted as R, and that is the company's cost of capital equity or equity capital. And then the third variable is denoted as G, and that is the constant growth rate for individuals for dividends in perpetuity. So using these variables, the equation for the Gordon growth model is given as the price per share is equal to the dividend to be paid in year 1 divided by the difference between the company's cost of equity capital and the growth rate in the dividends. So let's consider an example of how to apply the Gordon growth model. So Big Mac PLC just paid a dividend of £1.5. If the dividend is expected to increase by 2% per annum at the market required return of 15% on assets with the same risk, how much should the stock be selling for? Now, first, we know from the equation that D0, or the dividend paid now, is equal to £1.5. The next thing is to compute D1, or dividend in year 1, by compounding the dividend today at the growth rate for 1 year and dividing the results by the difference between the market return and the growth rate. This gives us a price of £11.77. An important question that emerges is, what is the cost of equity capital? So companies have two main ways of financing their activities, either by using equity or debt, and oftentimes a mix of debt and equity. And either of them comes at a cost. Therefore, there are many ways to compute the cost of equity capital. So one of them is the use of the DDM approach, or the dividend discount model approach, by rearranging the formula and solving for R, which is the cost of equity capital. That is the return shareholders or owners of the company expect from their investment. This is the first step to understanding how the discount rate used in estimating the price of a stock or an investment is computed. We will advance this further in our next section. So for those of you who are interested in reading some more, these are some vital references to consider. Thank you for watching this video and look up for the next video. Thank you.